Hi, Larry Berman here, and here's what's on my radar this week. Well, the new year started off with quite a hiccup for markets here. I think markets were quite surprised at the Fed meeting minutes this week as to how hawkish the Fed has turned at their December meeting, and with the January 26th FOMC heating up, should be very, very interesting. Now, there's a lot of narrative in markets this week about how the Fed should attack inflation pressures that surprise them. And I'm hearing more and more narrative that they don't want to raise rates aggressively and flatten the curve. And I don't mean flatten the COVID curve, I mean flatten the yield curve, which would imply slower economic growth, as opposed to keeping it steep, which would promote bank lending, keep money easy in the short end, push longer rates higher to fight the inflation effects longer out the curve. And I think that means more QT and unwinding of the balance sheet. But then we heard from Daly this week, and she said, no, we're not going to do QT until we start raising rates and they're normalized. So there's a lot of debate on the Fed, which means there's a lot of debate in the market, which means there's a lot of uncertainty. But we expect now January 25th to be a live meeting, in the sense that we'll find out more about further discussions on which way they're leaning. The more hawkish, the more bearish for equity markets is broad equity markets, is the flattening of the yield curve. The more bearish for large cap tech is the QT and unwinding of the stimulus from that perspective, because that's why you're seeing Bitcoin break some levels, sell off. That's why you're seeing large cap tech and the speculative names in equities that have been blown up on liquidity and not much more start to come unglued, and so we're seeing that across some of the great companies that for the ARK ETFs, for example, a lot of great companies in there, but grossly inflated because of liquidity issues. Again, anything that has been inflated because of liquidity issues are the biggest risk to the equity markets. Banks should be okay, steep yield curve, energy should be okay, inflation pressures and supply issues and so forth. So there are sectors that will do well. This year, increasingly, is going to be more about being in the right place at the right time, where broad exposure to markets like the S&P 500 that has a big exposure to some of these more overvalued areas are going to present a bit more of a challenge. So maybe a bit more of a stock pickers market this year than it is going to be an ETF players market. Having said that, uranium had a great week, and sectors. So you can play sector themes with ETFs as opposed to trying to pick the right companies. But if you're thinking about broad market exposure, I think this year it's more about stock picking and sector selection, again, by way of ETFs, than it will be about broader exposure, and more feel that that's going to be a big part of the year. So what else is going on? Geopolitical risk, quiet. It's interesting. I think for the first time ever, we're getting the Bank of Canada and the Fed having a decision on the same day. I don't recall ever in my career that that's ever happened. It may have. And it'll be interesting, because the employment numbers that came out this week in Canada were far stronger than in the US, and it implies that the Bank of Canada should be more aggressive, which means the Canadian dollar should get stronger, especially if backed by supply issues on the energy side, at least for the next couple of quarters. And if the Fed is not going to raise rates, and the bank will raise rates because they've stopped QE, and the size of their balance sheet relative to the Fed is insignificant, then I think you have a case for a stronger Canadian dollar in the short run. And so think about investments that way. Canada probably outperforms, more banks, more energy for a little while. And we've increased our exposure to Canada in some of the portfolios as well because of that. Bull and bear pick of the week. So what are we bullish on? Well, we're bearish on the same stuff. Large cap tech, long duration, sensitivity, rising rates, all those things remain our key avoid areas. Last week we put out uranium, and these we saw that, Chinese tech, boom. So money's going to rotate, and it's going to rotate into some of the areas that did really bad last year that have some themes. The only one that hasn't moved yet, medical marijuana. It's a name we were fist pounding positive on that the U.S. administration was going to get done. And as it's going to be more difficult for them to get spending bills done, but there will be a bill. It should include banking reform. That should be the catalyst in Q1 to lift that sector. And that would be where we would look to be nibbling for on the long side here. We've already have those bets on and we're underwater, so I'm not adding to it at this point, but it is something to make sure you have some exposure there, because I think it's fundamentally valued really well now and should have a huge catalyst for a double or triple easily from these levels looking out a couple of years. Have a great week, everyone.